everybody, and welcome to this edition of Hardman Talks. Today, I'm pleased to be joined by Neil Sinclair, the CEO of Palace Capital, alongside Stephen Sylvester, the CFO. With no further ado, let's go on to Neil Sinclair. Neil, over to you.
So we announced our interim results last week for the year ended 30th of September. So we are experts in regional property. That's what we do. We don't invest in London at all. We invest outside London. Regional returns have outperformed London for a number of years now, and offices make up 43% of our portfolio. Needless to say, working from home is a big headline at the moment, and it will cause certain changes in the office market, whereby it might be a little bit more flexible, but we're pretty clear. The demise of the office market, which was rumoured on a couple of occasions prior to this, never happened. We don't think it'll happen now. People will return to the office, mainly because they can meet other people, and working from home full time for a lot of people causes quite considerable stress. So our stock selection has been crucial to us, and you'll see a little further along that's whether the impact of the COVID storm, because we've maintained stronger occupancy and very strong rent collection. And you heard the Chancellor yesterday talking about levelling up and talking about the importance of the regions where we see a hub and spoke model. You also heard yesterday he's not only launching a fund, but in addition, he's going to move the infrastructure. He's going to form an infrastructure bank, and that actually is going to be headquartered in the north of England. These are our top 20 tenants. What happened, say you understand about rent collection, when the lockdown started at the end of March, we assembled in the office and we had to consider how we're going to get the rent in when firstly the government is imposing a moratorium, and secondly you've got people that have closed down and were not trading. So that caused all sorts of problems. And we decided the best way to handle that was for us to contact all our tenants. We have our properties externally managed by some of the leading firms, but we decided that any discussions with tenants had to be direct with us. So we made contact with over 200 tenants because we wanted them to know the difficulties they could pose if they didn't pay rent, and we wanted to know what their problems were. And we thought dialogue was the best way forward. And you can see our top 20 tenants. The third one down, Accor Hotels in Northampton. They're paying $510,000 a year plus a turnover rent. They closed, and they said they wanted 6 months rent free, and we agreed to give them that. But in return, we extended their lease by 5 years. So we've now got them till 2032 and not 2027. Not on the list is a company called Gravity, also in our building in Northampton. They had a break clause in 2029. That has been removed. In return, they've got 9 months at half rent, not the full rent. And a week before last, we did a deal with TGI Fridays at our scheme in Halifax. They hadn't paid rent since last March. We were having a real struggle with them, but eventually we agreed a deal. We agreed that up to that time, they would not have to pay any rent, but in return, they would have to extend their lease by 3 years. So if you look at that list, we've got quality tenants. This is why you're seeing rent being paid. Rockwell, Accor, Wix, Apcoa, all big companies. And if you turn on to the right, Bravissimo are big retailers, but they occupy an office building of ours in Leamington Spa. Because all their retail outlets shut, they discussed with us about deferring the rent. We agreed to defer it for 6 months, but they've now recommenced paying rent. And as of the moment, everybody's paying. And it's the quality of the tenants that's enabling us to do that. And that's 44% of our passing rent. So we've been over 90% since lockdown, 96% for the March quarter, 94% for the June quarter. We're already at 83% for this quarter, with monthlies to come, some quarterly payments We've moved to monthly to ease cash flow for tenants. That's one of the things we agreed to do. Obviously, last April, when things looked a bit bleak, we decided to not pay the dividend just to see how things would pan out. We did not know that our rent collection would go above 90%. We thought it'd be a good deal less. So in consequence, we cancelled that dividend, but we recommenced the dividend. Last one was payable in October, and we've got another one coming in December at a minimum of 2.5p per quarter. We're hoping towards the end of the year that we can increase that slightly. Hudson Quarter, I'll talk about in a minute. That's our flagship development in York. Completes in March. It was going to be January, but the pandemic caused it some delay. We have sold 36 apartments out of 127. We've also done some lease renewals and rent reviews. We haven't done as many as we normally do, and that's because everything is terribly slow at the moment. I don't know whether it's working from home, but everyone's taking ages doing anything. So in consequence, as an example, we've got a rent review we just finished in Southampton, due last May. We are still waiting for the arbitrator to determine what the rent is. We still don't know. It'll be backdated. It's late, but that's what we have to put up with at the moment. As far as our debt covenants, which Steve will talk about, we had a problem in April, but no problem in July and no problem in October. And so our priority focus has been on rent collection, and by working closely with tenants, we've achieved over 90%. We decided beginning of April, liquidity was what it was about. Maximize liquidity, so strong rent collection, and start selling some properties that no longer were core to us. So working capital control was very important. All non-essential capex was paused. Although we're doing this flagship scheme in York, we've got no other significant development on which we're spending any money in the next 12 months. The leisure sector, I will talk about in a minute, but basically, we've got two significant leisure schemes. They've been very challenging. You all know what's happened to the hospitality industry, but it's pretty clear that the bottom of that market was hit round about August, September. Because in August, September, I went to Halifax, spent a day there. I went to Northampton, spent a day there, and we had absolutely no interest in any of our vacant space. Since that time, we've agreed 2 lettings in Halifax. We've agreed a letting in Northampton, and we've got an offer in this morning on quite a lot of the vacant space at Northampton. So our view is pretty clear, but although the media won't say so because there's no statistics, there is no question that the leisure market has begun to turn.
So if I can just talk through some of the financials. First of all, liquidity and rent collection, as Neil has said, outstanding performance over the last 6 months from our asset management team. March quarter 96% collected, June quarter 94%, September quarter, which we're still in, takes us through to Christmas. We're at 82% collected, with 13% to come via monthly. So every quarter since lockdown, we've achieved over 90%, and our expectation is the majority of the outstanding amounts will get collected. We've had a couple of CVAs, 3 CVAs over the last 6 months, which has cost us about £200,000 in income. So in the grand scheme of things, immaterial, and overall liquidity is looking very strong. So a summary of our financial performance for the 6 months. Key numbers to pick out: adjusted earnings per share 7.3 pence. That is then that fully covers the dividend per share of 5p, dividend cover of 1.5 times. And on the balance sheet, you'll see the portfolio value now up to 281.6 million, cash of 14.3 million. So overall, loan to value is up to 42%. That was expected. and that's up from 38% at March because of the capital expenditure at the York development. So here's a breakdown of the profit reconciliation in the profit and loss account. The £3.4 million is adjusted profit after tax, or effectively the recurring earnings achieved in the period. You can see the significant amount going through the P&L this 6 months is revaluation losses of £10 million. That is the fair value estimate that Cushman's, our independent valuers, have provided on the basis that they've valued all our properties and they've marked down effectively £10 million across the board. That actually compares, that's on a like-for-like basis, that's 3.5% reduction versus a benchmark of 3.7%. So we are ahead of the benchmark, albeit fairly close at this stage. And then overall, our loss for the period, £7.2 million as a result. And the table to the right, you can see our track record in terms of paying out dividends and the dividend cover that we have achieved. So a breakdown in terms of that £10 million revaluation loss. It's important to note this isn't crystallized. This is an estimate of values from an independent valuer. They did take out the material uncertainty clause that they included back in March. And you can see over £6 million is to do with the office sector. Well, that is our core sector. And you would expect that, given that almost half of our portfolio is made up of offices. A couple of the key properties in that sector, one of them down in Southampton, was marked down as a result of a lease break coming up for next year, which the valuer had to mark down, but actually that date has since transpired, and so they will have to mark that property valuation back up at March. The other property would have been 249 Midsummer Boulevard in Milton Keynes, where we lost two of our core tenants there. Their leases expired as we expected. So that's those two properties had the main impact on our office sector. We have two properties in the leisure sector, and as you can see, £3.2 million marked down in valuations again, and that really is down to market sentiment and where valuers have a view on the leisure sector. And Neil will give you a bit more colour on that sector and how we feel a lot more confident in terms of where our properties are heading. This is the net tangible asset bridging chart, and really you can see we had an NTA of 364 pence per share at March. That's come down to 347p or 346.9p in September, and the key item there is those revaluation losses that has pulled that down. That figure is important because that is effectively what gets compared against the share price. That's how you determine what discount or premium the shares are trading at. So if I can just talk through our debt as it stands at the moment, we have facilities with the majority of the clearing banks. There's no debt due to expire in the next 12 months, although we do have the Barclays development facility, which is charged against the development up in York. As Neil said, the practical completion is March next year, and we have then until January 22 to repay the debt. Now, in terms of the big figures, I'll talk you through that in a minute. But as for the other facilities, none are due to expire. So a fairly stable portfolio as it stands. The important thing in this last 6 months has actually been around debt covenants. Because rent collection has come under scrutiny, tenants stopped paying rents initially back in April, particularly in the leisure and hospitality sectors. So we had to work with our lenders. We had covenant waivers from two of our lenders back in April to manage that. But in fact, we have been covenant compliant through July and October. and we expect to be compliant for the foreseeable future. Loan to value, if I can just explain, so that's increased to 42% across the portfolio. That's partly as a result of the like-for-like valuation drop of 3.5% across the valuations, but also because we've spent £12.8 million of capital on our York development. We expected that loan to value to increase, and once we have sold all the residential units, that loan to value ratio should fall towards 30%. In terms of HQ, in big picture, we are expecting to generate just over £50 million in residential proceeds. The debt is about half of that. So once the debt has been repaid, we'll have about £25 million of cash available to redeploy in income earning properties. Neil, back to you.
Yeah, so you can see our portfolio is £281 million, which I mentioned before. You see our net initial yield at the moment just under 6%, reverting to 7.3. 16.9 is our rental income, with a rental value excluding York, which I'll come to, of 20.2 million and a 4.9 year WALT. Our void rate is 15%. We keep some of our properties empty because we're looking to refurbish or redevelop them. So if you look on the right, what's quite interesting is our performance. You can see there that hello, yeah, I'm on, okay. Yep, got it, okay. So in the main, we perform very well in terms of industrial, offices, even retail to some extent. But offices rest of the southeast, we haven't performed that brilliantly, but all the rest we have. So we had 13 lease events in the year providing additional income. I think I told you we normally do more than that, but everything has been incredibly slow. But the ones we did do were all ahead of estimated rental value. So we've got sustainable rents across the sector, and this is the difference between London and the regions. So London, you've got offices anything between 80 and 120 pounds a square foot. Our office space in the regions, actual average rent is about £16 a foot. And we think going forward, companies are going to look at cost, and they will look whether they need to pay the 80, 90 pound a foot in London. Remember, you've got rates as well, which are normally half the rent. And it's a big cost. And we're definitely detecting interest coming from companies based in the south, in the north. We're seeing that. Looking at our rents across our sectors, the rental value of our leisure properties is slightly above the rents we're actually getting, but that's not unexpected. It's better with industrial, retail, warehouse, also rental value slightly above what we're getting at the moment, but that is a sector that's showing sign of recovery. And retail, we're not doing too badly, but then again, we've only got about 6% in retail. We've got very little exposure to it. We think we are going to capture quite a lot of this reversion when people start going back to their offices, which they actually will. We know about demands both in London and the regions where people are looking, not announcing they're looking, but we know they're looking. And we see that increasing as we come out of lockdown, as we deal with the vaccines, and as people go back to work. So here's our rent roll. I told you about the contracted rent roll, 16.9. We have vacant space, which if we let it, we get another 1.9 million. We then got vacant space held for refurbishment or redevelopment, property in Leeds, and we've got a property in Milton Keynes, both in absolute prime locations where we are planning something quite interesting. 400,000 a year is in respect of rent free. Lease renewal, as I told you, another 300,000 a year. But in terms of estimated rental value, there is £500,000, which is over rented. So our estimated rental value is 20.2, but Hudson Quarter, which is under development in York, has an office building, and we expect to achieve circa £900,000 a year from that. That will take us to 21 million. So this is a CGI of Hudson Quarter. We've got 127 apartments, 39,500 feet of offices, and we believe we will generate a gross development value of 69 million, which will give us 20 million cash on cash. All the rest, we've only got a few million left to spend on the contractor, and that's funded by Barclays. We've sold 8 further apartments as between 1st of April, 30th of September. Quite interestingly, we agreed to sell 2 last Friday. We noticed a definite pickup in the market, and there's also a particular pickup in the Middle Eastern market, and that's possibly because the air corridor is now open as between the UAE and the UK. We've got considerable interest in Hong Kong, but at the moment the air corridor is not open. So we've pre-let 4,500 feet already, which is on the ground floor of one of our residential blocks, to Knights, the quoted law firm, at £25 a foot. In terms of the office building, which is about 35,000 feet, which you see on the right, we are talking to a potential tenant for half the space. We should know more next week, week after. We're reasonably confident, but they're also looking at Leeds. It's not money, it's whether they go to Leeds or York. If they want to go to York, we are the only game in town and they will come to us. So opportunistic development is how we look to make our money. So high speed, Uxbridge, we've got a property, we've got consent for 7 units. We're going for a consent for 3 more, but that's a bit small and we're unlikely to do it, and we'll probably sell it. Millbarn Medical, we've got a possible mixed use scheme there, but a tenant's in occupation and has got a break clause in March 2022. And we don't know until September of 21 whether they're going to remain or not. Milton Keynes, we have an absolute prime site. It's about 3 or 4 minutes walk from Milton Keynes Central Station. Santander are building their new 1 million square feet digital HQ in Milton Keynes, and it's 100 yards from our property. We are planning a scheme of over 100,000 feet, probably residential, possibly offices, or even hotel. Leamington Spa is not dissimilar to York. It's a very classy Midlands town, high residential values. We got 2 office buildings fully let until November 2022. We've got the potential for 70,000 square feet, very similar to York in terms of type of scheme. And we own an 1.5 acres in the middle of Leamington Spa. And finally, Manchester, which has done really well over the last few years. We've got a building there of 75,000 square feet. It's got potential for double the size because we've got a very big open car park. And again, we only buy buildings in good locations. And this is 3 or 4 minutes walk from Manchester Piccadilly Station. So you can see the cash on cash returns that we do. Hudson Quarter York was bought 7 years ago. And you can see the IRR there is 17%. High Street Weybridge we acquired with a portfolio 6 years ago. We got consent. We were thinking of developing it, but we don't want to increase our gearing. So we've decided to sell that one. And we're in the final throes of agreeing a sale on that particular property. You'll see what the return is on that. Bolton House, Manchester, I spoke to you about. We bought that for 10.6 million. And it's recently been valued at 15.23 million. So an ungeared IRR return there of 11%. Kiln Farm was acquired when we bought the Quintain portfolio in 2013. Typical Palace deal, 3 office buildings, 2 let to Rockwell for 8 months. We convinced them to stay and they took a new lease for 12 years and we've refurbished their building. And a building next door fell vacant about 4 years ago. We refurbished it and let it to absolute huge European company, Monnier Redland. And you can see there, we've got an IRR return of 19%. And finally, Aldi was acquired with the Warren portfolio 3 years ago. You can see the rent that we were getting until 2030. They wanted the land we owned next door, small bit of land, and we gave them that, but in return, they took a new lease for 20 years with an increase in rent of nearly 50,000 a year. So all in all, that showed an ungeared return IRR of 15%. This is Northampton, the leisure scheme I was telling you about. Gravity Fitness, when they're open, and they're reopening next week because they're in tier 2. They do rock climbing, trampolining, crazy golf. It's a great concept. They're backed by the Guinness family. They've got units across the country. They are a very, very well run organization. Acco, I spoke to you about before, where we extended the lease. Gravity, we got rid of the break clause. We've just authorised £1 million of expenditure to refurbish this scheme. As I said, we've got talks on to let most of the remaining space, and we can see a strong recovery, particularly on this one.
So in terms of looking forwards, we have a disposal strategy in place. We have a number of assets that we've earmarked for sale, and one of them being the Weybridge asset. So that will release cash into our working capital. We've got the residential sales that we're progressing with at York. As Neil said, it's been slow, but we expect to continue progress there. We've got the space that we need to let in the York office building. Our loan to value as a group is looking like it will come down from 42% towards 30% once those residential units have been sold. And we actually think that there'll be some distressed opportunities next year as we come out of lockdown, as banks perhaps are not as lenient as they have been during this last 6 months. And we want to be ready to take advantage of those. So we are talking with a number of equity partners on a couple of transactions. So in terms of summary, we're a regional expert. We focus on the regions. We have done for many years now, and we think that our stock selection has stood us in good stead. We've got good tenants in good properties in the right locations. We've got income reversion. We've got capital growth upside, specifically at York Development, where we think there's a £10 million surplus to realise over the next 12 to 18 months. And we also have a medium-term pipeline. The REIT status has certainly helped, and the asset management team that we have are first class, and we think we've got a great platform with which to access the regional story. And certainly as the government focuses on levelling up, that is an opportunity that we think we can take advantage of, and we're well positioned to do that. So thank you for listening. If I can hand back to Keith.
Stephen and Neil, thank you very much. That's very interesting. I'll start with some big picture questions first. So the first one I've got in is, there are a number of Me Too companies listed in London that are pursuing a similar strategy to yourselves. Would you consider merging with any of them, as the enlarged market capitalisation would likely attract more interest from institutional investors, thereby helping to address the valuation discount? Second question from the same party is, separately, has COVID changed your view about the optimal portfolio mix that you envisage for Palace Capital?
Right, so the first question is all about consolidation. So obviously we're well aware of that. And I can tell you 2 years ago, we bought a stake in a company called Circle Property because we saw an opportunity there by merging together. It would suit them and would suit us, but they weren't interested, not in the slightest bit interested in merging with anybody. And in consequence, that didn't go anywhere. We did look at 2 other companies, but having looked at the portfolio, we decided they weren't for us. So we are looking. We do believe in consolidation on the right basis. And if we can find a super opportunity, of course, we'll look at it. But it's got to be the right one. And it's got to be that we think will increase value for shareholders. What was the second question, Keith? That was about COVID.
Has COVID changed your view about the optimal portfolio mix?
Well, I think I would say that pre-COVID, we were looking to exit leisure anyway. And we intend to sell Northampton and Halifax, but not now, mainly because it's not a great market for leisure investments at the moment, but we think it will be. We're under no pressure at all. We're getting very strong cash flow from both those schemes. So there's no real point in selling at this part of the cycle. But I would say in the next 2 to 3 years, we would look to exit that, and over a period of time, exit our retail as well, and focus on industrial and offices.
Okay, next big picture question is, do you see development as an ongoing part of the business, and does that make your returns, or will that make your returns lumpy and unpredictable?
So remember, we're a REIT, so the amount of development we can do is limited anyway. We look on ourselves as investors rather than developers, and you'll notice that at this point in time, we've only got one development on, and that finishes in March. We've got some in the pipeline, which you saw in our presentation, but there's nothing that's going to start in 2021. We're looking at 2022, and there may be one. But I would say, whilst we're this size and until we're much bigger, we wouldn't contemplate doing more than one at a time. But provided we see the returns, and you know, in Hudson Quarter we saw the returns, and that's why we went up. That's when we decided to go ahead with it.
Okay, I've got a question here from Mark. I won't say his surname. Mark's asking, what LTV are you aiming for in the medium to long term?
Yeah, so we've often said our range is between 30 to 40%. So we're just over the top of where we'd be comfortable. Clearly, there's a reason for that, and we expect it to come back down to the bottom end of that range. But I think medium long term, between 30 to 40%. Okay,
Mark's got a second question, which is, which properties are classified as trading properties in your accounts?
Okay, so that's just it's a classification. It's development properties. So just to clarify, the Hudson Quarter Development is split. There are 3 buildings which are residential and 1 building which is office. The office remains an investment property, even though it's under development, but the residential element was transferred into the category of trading properties because they are being sold.
Okay, question from Rob B. Are you having problems with EWS forms on the Resi development at York?
No, because it's a brick built building. We have no cladding.
Okay, thank you. Judy P. How do you think working from home is impacting on Palace Capital? I think it probably means about the tenants rather than you, or maybe it does mean you.
I'm going to let Stephen answer that question.
Yeah, because if it was us, I'm working from home, Neil's working from the office. So we're socially distanced. As you can see, actually, my background is the CGI from one of the rooms from our York development. So if anyone's interested, please speak to me afterwards. No, I think work from home is, it's something that everyone wants to talk about at the moment. I remember in the initial couple of months, there was a lot of talk about, is this going to transform the industry? Is the office dead? And then as we've progressed through this, more and more people have realized they've got to be in an office. They've got to be somewhere where they can collaborate with people. And, whether you're young and you're at the start of your career, you need to be in the office. You need to be around people if you're going to grow and develop. If you're, more advanced and in the latter years of your career, you need to be around. You need to be sharing your, communicating with your networks and building your team. So, ultimately, people weren't meant to work in isolation, and the office is effectively it just provides the format for business to be done, and that has changed over the years, but demand for our office space, we believe, it's changed. The type of space that people want is changing, and I think couple that with ESG requirements, environmental, it just means that actually, you need to stay on top of your buildings. You need to make sure that the space you're providing is what tenants are after, and that's very much a part of our core business strategy. It's when tenants vacate, we take their space back and we refurbish it to the right level. We make sure that broadband is connected. There's plug and play. We want to make sure our tenants can move into our buildings and operate as efficiently as possible from the word go.
Do you think this means? Do you think we've gone through the peak of open plan offices?
Well, it may not really. This in a couple of years' time, we'll all look back and think, what was that pandemic we had 2 years ago? That's the way it goes. That's the way it goes. And it's quite interesting in terms of working from home. When the lockdown finished in July and August, the return to work and offices was far greater in the regions than it was in London. The lowest area was London. And that's probably because of the commute. So do you want to get the 20 to 6 in the morning train to Waterloo and, not get a seat? I mean, I'll be honest. Whereas in the north, it's totally different. And in consequence, I know Leeds got back to 60% were working in the office. Of course, in Europe, it's much higher. Paris was 75%. So my view is people will return to work in the office. And before COVID, there was already a day a week at home working. It's nothing new. It's just been more profiled.
I've got a related question that's come in from an attendee who wants to be anonymous, saying, are flats going to sell at Hudson's with working from home people looking for gardens? If not, what are you going to do?
I'm glad you asked that question, or she asked that question, because we are spending a fortune on landscaping at Hudson Quarter. Hudson Quarter is on a 2-acre site, and we've just started the landscaping works, and we've got a huge courtyard, right? Absolutely huge. You're going to feel as though you're in the country. So, in my view, we decided to do that 2 or 3 years ago. We thought we've got to do that. It's city centre living, but you don't think you're in the city centre.
Another question. Does the company, or would the company, consider buying in its own shares as a way of reducing the large gap between the NAV and the share price?
Good question. Comes up pretty well every board meeting. At the moment, we keep it under review, but we're not looking to do it. 2 reasons. Number one, by doing it, you increase your gearing, and we're not looking to do that at the moment, and we don't see much point. And second, I think there's better things we can do with our money, to be honest. We want to preserve our cash to do the things we want to do. And the third problem is, of course, you get smaller. And one of the things we're looking to do is to grow. And if you buy your own shares in, you go the other way.
Okay. Final question, I think, was going back to leisure, and to some extent you've answered this, but I'll ask it anyway. How many of the tenants have got behind with the rent, and is any space vacant?
Yes, we have got some space vacant. In Northampton, we've got 21,000 feet vacant, but we've let about 1,500, and we've got an offer in today for 11,000 feet. They've been negotiating for some weeks, but we're now getting towards heads of terms. There's not much available in Halifax. We've just agreed to let 1 unit. 7,000 feet in Halifax, sorry, 6,000 feet, next door the NHS, has been empty since they built it in 2012. Now, we bought it in 2016, and I can tell you it's never been let. We put the power in, the previous developer did not. We put the power in, put a shop front in, and that's now under offer to an absolute first-class tenant. So after 8 years, we've actually got a tenant, right? And the interesting thing is that tenant is pushing us. They want to get in as soon as they can. So, as I say, it's time to look up a bit.
I said it was the final question. I've got one more, so I'll ask one more question, which is from somebody called S. What opportunities are you looking to buy in 2021?
Right. So if you look back, we bought a small portfolio in 2011, but in 2013, 2014, we bought a subsidiary of Quintain for nearly 40 million. And that was a distress because we paid 39.25 million, but they owed the bank 38 million. And what happened was we bought the company for £1 million. Now, by doing that, we didn't pay 5% of 39 million, which is stamp duty. We paid 0.5% because we bought the company of the 1 million. So we saved nearly £2 million in stamp duty. And we did exactly the same thing with Property Investment Holdings. That was in distress. It was a company that got into trouble with long dated swaps, really serious trouble. That was a £32 million portfolio, but the banks would pay back 28 million, and we ended up paying for the company 3.5 million. So we're looking in 2021, and we don't see them coming up until the spring, for corporate opportunities preferably, and where you've got that situation where the loan to value has gone over the top and the bank is very uncomfortable. That's what we're looking for.
That's great. Neil and Stephen, thank you very much for your time. Thank you everybody for attending this, and we look forward to catching up with you again on the next set of results.